Good morning, everybody. Happy Wednesday. It is Wednesday, October 29th, 2025, and it's time for our weekly webinar. Good to see everybody. We are going to jump right into our program. This week, our financial focus is going to be how to change your Social Security benefits. So this comes from a conversation that I had with someone who attended one of our classes. They recently elected their Social Security benefits, and it may make sense for them to change. So we had a conversation about what does that look like. This person didn't know that that was a possibility. We've had conversations like that before, so I'm going to share the options with you today at about the 30-minute mark. The questions are, what happens if you change your mind about when to collect your Social Security benefit? Can you make changes after you start collecting? How long do you have to do that? What are the requirements? I'm going to go, and even the tax effects. So I'm going to go through these things at about the 30-minute mark. Again, as I always say, if you've enjoyed this webinar, please share it with your friends. We've gotten a lot more shares of our podcast. Please, if you're listening to the podcast, please feel free to share it with your friends. And hit the like, subscribe, and notification buttons on this YouTube video, and that'll help more people find us and benefit from this program. Okay, so headline today that just came out, I guess Friday, October 24th, was the increase of our Social Security benefit for 2026. So the cost of living increase for 2026. We received notification from the Social Security Administration that is going to increase by 2.8% in 2026. So you're going to see a rise in your Social Security benefit if you're collecting. And more people are going to be subject to tax on that benefit, unfortunately, because as Social Security increases, we see more and more people caught in the taxable portion of the provisional income brackets, which haven't themselves increased since about 1983. So here it is today in 2025. That's a long time. So good news and not so good news when it comes to Social Security. Let's jump into our slot report here. I'm going to share my screen with you. I'm very excited that I'm going to be traveling to Austin, Texas next week to be with the Slott group. This is one of my favorite times of the year. Twice a year, we go for these live education events, and I always come back with a lot of material. So I'm excited to join these folks, and I'll be sure spending some time with Andy Ives. Today's mailbag is eligible designated beneficiaries. So read along with me here. If you're listening to the podcast, I'll go as slowly as I can. If you hear anything that interests you, you can always come back and view the video on YouTube. So Andy has this question. My client is age 71 and divorced. He is the primary beneficiary of his ex-wife's IRA. She just recently passed away this year at age 67. I believe my client is an eligible designated beneficiary because he is not more than 10 years younger. I'm scrolling up a little bit here. He is not more than 10 years younger than his ex-spouse. As such, I believe my client can choose to take RMDs, required minimum distributions, over his own single life expectancy, which would begin in 2026, but no later than April 1st, 2027. Am I correct? Let me break this down a little bit. So this is my aside here. This starts with my client is age 71. So this is either a financial advisor or a CPA, likely. And they're asking a very, very good question here. So basically, this person inherited this IRA. Is he now a eligible designated beneficiary, even though it's an ex-wife? If they weren't if they was still his wife, certainly they would be an eligible designated beneficiary as a spouse. There's a really good question here because he is not 10 years or younger. So good news, this person's asking the right questions. But they're blending some of the rules, and Andy's going to talk about that in a second. I don't mean to steal your thunder, Andy, if you're listening, but he then this person, his name is Brendan. So he writes my client can then choose to take RMDs over his own single life expectancy, which would begin in 2026, but no later than April 1st, 2027. So he's blending the rules a little bit, and Andy's going to talk about that more. But this is Brendan. If you are a CPA or a financial advisor and you happen to be listening to this podcast or YouTube, come out and join us so that you have the correct information all the time about these requirements. But good for you for asking the question. because too many people make the mistake of blending these rules together and creating problems for their clients. So Andy writes, Brendan, you are correct that your client qualifies as an EDB or eligible designated beneficiary under the not more than 10 years younger EDB category. Since the ex-wife died in 2025, your client can begin annual stretch RMDs in 2026. Incidentally, since the ex-wife had not yet reached her required beginning date, your client could choose the 10-year rule with no RMDs in years 1 through 9. So they have a couple options. Regardless, assuming he elects the full stretch, he will use the single life expectancy table to determine his original RMD factor in 2026. And another aside, you as listeners, if you want a copy of the RMD tables, whether it's the uniform life expectancy table or the single life expectancy table, you can download those at our website at attleboroughwealth.com. I'll just put that up here for a second, attleboroughwealth.com. You go all the way over to the resources section of the website under the slot corner and scroll down, and you can download the uniform lifetime table, the single life expectancy table, or and a lot of other tax planning tables. So back to what Andy was saying. So identify his age using the uniform lifetime table, or using the single life expectancy table. Identify his age at his birthday in 2026, and use the corresponding factor. If he turns age 72 in 2026, that factor is 17.2. For each year thereafter, he will subtract 1 from the preceding year's factor. This is another big mistake that people with inherited IRAs make. They go to that uniform lifetime table and they line up their age with the factor every year, and that's going to actually create a larger than necessary required minimum distribution. Note that he cannot delay his first RMD until April 1st, 2027. That option is not available on inherited IRAs. He must take his first RMD by December 31st, 2026. So that's a big one. He cannot delay. So an individual with their own IRA can delay, I'm trying to highlight this, can delay their RMD, their first RMD until April 1st of the year following the year that they turn the eligible RMD age, which is currently 73. But inherited IRA, you don't have that option. You have to take the RMD by the end of the year. And in this case, December 31st, 2026, the end of the year following the year. So the next question. My wife inherited an IRA from her uncle in 2019. She was taking RMDs from it each year. She died last year. I am age 53. Can I roll this IRA into an IRA in my name and stop the distribution? Andy's answer is condolences to you for the loss of your wife. Since this is an inherited IRA and not your wife's own original IRA, that makes you a successor beneficiary. Successor beneficiaries, no matter who they are, spouses included, are bound by the 10-year rule. Since she passed in 2024, your 10-year drawdown period starts this year, 2025. Additionally, you must continue taking annual RMDs based on the same single life expectancy factor that your wife was using. So this is much different than the previous question. The previous person was a direct beneficiary. This person is a successor beneficiary, and there's different rules. You'll see there's no option for their own the stretch. They have to use the 10-year drawdown period. In addition, they don't use their own life expectancy table. They use the same age factor that the wife was using, the original beneficiary was using. So I know it's very confusing. Essentially, you step into her shoes, talking about the deceased wife. Essentially, you step into her shoes and follow her same factor, subtracting 1 each year. Had this been your wife's own IRA, you could do a spousal rollover into your own IRA, but since it is an inherited IRA and you are a successor beneficiary, a spousal rollover is not an option. And the moral of that story, folks, is just make sure that you're consulting a qualified financial planner or a qualified CPA when you're addressing questions like this, because you can see it can get very, very confusing. So this next notice is from just today, from Sarah Brenner. New Code Y is optional for 2025 QCDs. So required, not required. A month ago, the IRS introduced a new Code Y for the reporting of qualified charitable distributions by IRA custodians on 2025 Form 1099-R. The IRS has now issued guidance on its website, making this new code optional for 2025. So let's give some QCD basics. The QCDs first became available in 2006. Now, I have to tell you, I had a moment here when I read that. I thought to myself, 2006? Surely Sarah made a typo there. So I went to Google, and as everybody does, and I Googled, when did QCDs start? Sure enough, they started in 2006. If I were quizzed on this, I maybe would have said, I don't know, 2012, 2013. But goodness gracious, 2006. It's so long ago. So QCDs first became available in 2006, and they were made permanent in 2015. The strategy has become increasingly popular among IRA owners who are charitably inclined. Boy, has it ever. With a QCD, IRA owners or beneficiaries who are at least age 70 and a half make a tax-free donation to charity directly from their IRA. Now, another aside, that 70 and a half here is very important. I'm going to just highlight it. We've got, this age has changed so many times. Many of you might remember that 70 and a half used to be the age that you were required to start taking required minimum distribution. Hear me when I say that used to be the age. It changed to, I think the changeover was 72, and now it's 73. And if you're born after 1960, it's going to be age 75. But QCD age has stuck at 70 and a half. You must be older, at least reached your 70 and a half birthday. So if you're, you've got to, it's not the year that you turn 70 and a half. It's, you've got to hit that date that you would actually be 70 and a half if we count it half birthdays. And why the heck don't we, by the way? So that's another confusing date for people, because it used to be it used to be just, you had to really worry about 59 and a half. That was the first year that you could begin taking distributions from your IRAs without any kind of penalty, with some exceptions. And there were some other dates too that had to do with some catch-up contributions, age 50, and maybe some withdrawals from 401ks in certain circumstances. But for most people, it was 59 and a half and 70 and a half. Well, now there's so many ages now. We've got the senior bonus deduction. We've got the super contributions that are only for people from, in a span of ages in their 60s, not 60 and above. We have different catch-up contribution ages. So, and then we have the QCD contribution age that harkens back to 2006 at 70 and a half. So it's still 70 and a half. An important benefit of a QCD is that it can be used to satisfy a required minimum distribution. The 2025 annual limit is $108,000 and is indexed for inflation. A one-time QCD of $54,000, also indexed for inflation, can go to a split interest entity, such as a charitable remainder annuity trust, a charitable remainder uni trust, or a charitable gift trust. That's one time. The qualified charitable distribution of $108,000 can be every single year. You can do an individual qualified charitable distribution direct to a charity at $108,000 a year per individual. So if you're a husband and wife, or spouses, you can each do one if that's what you want to do. So you don't pay tax on that distribution if it's a qualified charitable distribution. This $54,000 to a charitable remainder annuity trust, split interest entity, or a charitable remainder annuity trust is a one-time $54,000. Sarah goes on to write, QCDs can only be made through a direct transfer of IRA funds to charities that qualify under the tax code. Gifts made to donor-advised funds or private foundations do not qualify. I highlighted that because we get this question all the time. I have a donor-advised fund. Can I transfer money from my IRA via QCD, qualified charitable distribution, to my donor advised fund and then distribute those funds? No, that's not allowed. In addition, the client cannot receive anything of value from the charity in exchange for making a QCD, and that must be documented in writing by the charity. We have a video about QCDs. We'll link that video to the description here. We talked in detail about the qualifications and requirements of the QCD. So here's the update as of, I think it was just last week. Update Code Y is optional for 2025 QCD. So required, not required. Historically, IRA custodians were not required to report a QCD differently than any other IRA distribution. There never was any special code on Form 1099-R to identify the QCD. Instead, it was up to the taxpayer to let the IRS know about the QCD on their tax return. For 2025 QCDs, the IRS changed this approach. Earlier this year, the IRS released instructions for 2025 Form 1099-R, which introduced a new Code Y for QCDs. The introduction of the new code for QCDs posed significant implementation challenges for IRA custodians, which led to complaints from the large financial institutions that serve as IRA custodians and their lobbyists. So what happened? They backtracked. On October 16th, the IRS backtracked and made Code Y optional instead of mandatory, which means I don't know who the heck's going to do it, for 2025 QCDs. The following language is now posted on the IRS website. The entry of Code Y in Box 7 of 2025 Form 1099 is optional. If you are completing and filing a 2025 Form 1099-R, you may choose to, but are not required to, enter Code Y in Box 7. So those of you that were waiting to see Code Y in Box 7, if you're doing a qualified charitable distribution, don't hold your breath. It's unlikely that we're going to see it. So go back to your self-reporting and record keeping on this. Okay. I hope that was helpful. Thank you for reading along with the Slott updates. Let's talk about the markets. We're in day 29 of the government shutdown. No end in sight, really. And it's really interesting because the markets remain really resilient. So as I'm looking at my screen right now, the NASDAQ is up, the S&P 500 is up. I'm not seeing the scroll in the Dow Jones, but it's really quite surprising. So last week we saw another positive week. U.S. stocks posted a solid week. The S&P 500, the Dow, and NASDAQ were all up at weekend. So when I talk about weekend, I'm talking about October 24th, 2025 in this case. International markets, both developed and emerging markets, also ended positive. CPI, Consumer Price Index data, while delayed, was released with both headline and core CPI coming in at 3% annualized for the month of September, which is lower than expected, but still well above the Fed's 2% target. So you and I might not think that the difference between 2% and 3% is big, but the Fed sure does. Despite limited data, the Federal Reserve is meeting today to decide on the target range for the federal funds rate. The market is pricing in an almost 100% probability that the Fed fund rate will be reduced by 25 basis points or 0.25% to a range of 3.75% to 4%, with further adjustments likely over the next 6 months. The bond markets reacted to softer inflation data with yields on the 10-year Treasury falling a bit. The yield, the 10-year Treasury entered the week last week at 3.99%, still pretty strong. The Treasury yield curve flattened somewhat. So, with a typical yield curve, we see we have lower yields in shorter, what we call duration bonds. So bonds that mature maybe 3 months, 6 months. A Treasury bond can go anywhere from 30 days to 30 years. So the idea is typically when we have this yield curve, the lower interest rates or the shorter maturities get lower interest rates, the longer maturities get higher interest rates. So it's this nice curve. Over the years, we've seen flat or inverted. So that means you're getting more interest for shorter term bonds and less interest for longer term bonds. And that's a difficult it's a difficult road to navigate from an investment point of view, and also doesn't bode well for the economy in the long run. So we're seeing a flattening of that yield curve from this some of the delays and some of the economic pressures. So that can be a signal. That flattening of the yield curve can be a signal of slower growth rather than inflation. Gold and other safe havens were relatively weaker as risk appetite improved. So that means more people are moving from gold into stocks again. When we're looking at, when we hear things like risk appetite, risk on, risk off, that's generally a comment about people moving towards stock. The U.S. dollar was slightly weaker last week. What do we have the week ahead? So Monday, we had the durable goods orders. That's a leading indicator of manufacturing activity, what we expect to see manufacturing to be doing. The new orders for durable goods in September increased by 0.4%, which was higher than the 0.2% increase in August. Yesterday, we got the Consumer Confidence Index. So that's a measure of consumer sentiment, which can indicate future consumer spending and economic growth. So what are people thinking about when it comes to their spending? The index for October fell to 94.6, a slight decrease from the revised September reading of 95.6. So we saw a drop in that. Today at 2 p.m., as I said, is the FOMC meeting, the Fed meeting, where they're going to announce the Fed funds rate. We also see, we should have had this already, or we probably have it right now, pending home sales that was released at 10 a.m. right when we went live here. Thursday, tomorrow we see the GDP gross domestic product for the third quarter, the first release of it. And we see the weekly economic index, and that's a composite index providing a snapshot of U.S. economic activity. On Friday, we see what's called the PCE deflator. So that's a the personal consumption expenditure index. This shows how prices for goods and services are changing. The Fed uses this as its preferred inflation gauge. So like we look at the CPI to look at inflation, the Fed looks at the PCE index. What are the major firms saying about what's going on in the economy globally, in the U.S. and the markets? There was a major investment firms gathering last week in Saudi Arabia for the Future Investment Initiative, or FII, to share their views on the economy and markets. Here's some positive outlooks. BlackRock, Goldman Sachs, and Blackstone expressed strong confidence in the U.S. economy and its ability to continue attracting capital. BlackRock CEO Larry Fink said that money has begun returning to U.S. assets, reversing a prior outflow. Goldman Sachs CEO David Solomon stated there is no obvious trigger for the near-term economic slowdown in the U.S. Blackstone's Stephen Schwarzman expressed confidence in progress on a U.S.-China trade deal. Morgan Stanley CIO and Chief U.S. Equity Strategist Mike Wilson discussed his outlook on a preliminary U.S.-China trade agreement. 2 bullet points with this. He discussed the trade deal, that the trade deal is a positive for equities, that's stocks, but notes there are still remaining hurdles for the stock market. The implication is that with trade uncertainty easing somewhat and the backdrop of major tech earnings and the Fed Reserve meeting, the market environment may remain favorable, although not without risk. So there are the positive outlooks that we're seeing out there, or from this meeting last week. There were some negative thoughts. Oaktree Capital CEO Robert O'Leary warned that the this is quotes, AI-driven economy-wide bubble may pose risks, particularly because direct lending has heavy exposure to software companies. A report by the International Monetary Fund stated that risk asset prices are well above fundamentals, and that's also a quote, risk asset prices are well above fundamentals, and that a sharp correction could occur under adverse shocks. So I'm going to say it again. We've got the big firms not being able to agree about what's going to happen in the U.S. and global markets. So how do you handle this as an individual investor? How do we handle this when we're managing our investments for our clients? So we take the approach of, first of all of our investment decisions are driven by our financial plan. You've got to have a solid and comprehensive financial plan. And say it with me, you should review this every single year. So if your financial plan is helping you make these investment decisions, then that gives you a strong foundation where you can build your asset allocation, some level of principal protection, and what we call account segmentation. And most of you know what I'm talking about, but if you don't know what we're talking about, we always post this video, the 3 pillars of investment management, in this video and on the podcast description. So we'll make sure that you have that. But you've got to have that strong foundation, and you've got to have these 3 pillars, and that gives you that strong foundation to be able to withstand these things, and having a reason for having your investments in different categories, and kind of setting aside the noise. We pay attention to all the noise. We have our ears to the ground. We pay attention to all the noise. We have an investment committee that meets twice a week. We think it's very, very important to pay attention to these things, but we don't want our clients worrying about them. So that's why you develop these strategies, the 3 pillar strategies, to give you that foundation so that you folks don't have to stay up at night. Let's talk about some specifics with the market. So what did the Dow Jones Industrial Average do last week? It was positive 2.24%, up almost 12.5% for the year, 12.49% for the year. Amazing. The S&P 500 was positive 1.93% for the week, positive 16.66% for the year. The NASDAQ was positive last week for 2.31%, positive for the year, 20.81%. The MSCI World Index, so not global companies, not including the U.S., was positive 1.25%. Hold on to your hat here. Positive 27.91% for the year, 28% almost for the year. These are global indices. I talked about this last week. We had I was having a phone conversation with a person who was asking me about investment processes and how we do things and some general education around it. And they focused on the S&P 500, S&P 500, S&P 500. And I told her that's a very Susie Orman approach. The just investing in the S&P 500. There are areas of the market that you want to take, you potentially want to take advantage of. And one of them are the global markets. Yes, they outperform sometimes or underperform sometimes, and sometimes the U.S. markets outperform and the global markets underperform. But this is an example where everything's kind of lifting, but the international markets are lifting very, very nicely. And if you missed out on that, boy, did you miss out. Emerging markets so far for the year. So global emerging markets, smaller economies. Last week, 2%, up just 2%, 2.05. Year to date, 32.35%. These are things you don't want to miss out on. That's the first pillar, asset allocation. Proper asset allocation will give you exposure to the broad markets around the globe. The MSCI Europe, Asia, and the Far East was positive 1.25%, up 27.90%. The MSCI World Stock Index was 1.78%, and that's positive 20.96%. And even bonds were up last week, 0.17%. The U.S. Area Bond Index is up 7.41%. It's October 29th. If we close out the tape for 2025 at these numbers, I think everybody would be very, very happy. So good news across the board. We hope it continues from a market point of view. All right. Let's move into our financial focus. All right. Well, it is time for the financial focus portion of our weekly webinar. And today's topic is how to change your Social Security benefits. I talked about this at the top of our weekly webinar portion. And if you want to go back and look at that, you certainly can. There's a lot of, I think, really good stuff that we talk about. The markets, some updates on qualified charitable distributions and IRA distributions, and some other great material regarding good planning strategies. But today, here in this section, we're talking about how to change your Social Security benefits. So this came about from a conversation I had with a person who attended our classes. And they said, I started collecting my benefits in April of this year. And this is a very common thing. When I was talking to the Social Security Administration, he said, they encouraged me to go back and collect the deferred all the way back to my full retirement age, go back 6 months, and they were going to hand me a check. They were going to send me a check for the amount that for the period of time that I hadn't filed for my benefits. So this person felt as though that was beneficial, and they had a lot of good reasons for collecting their benefit at the time, but they were starting to question whether that was the right decision. So first of all, they started their benefits now past their full retirement age, or past age 67 in their case. And they triggered it in April of this year, but the representative on the phone for the Social Security Administration said, well, wait a minute, you can go back and we'll send you a big check for the past 6 months. Well, that's enticing. But he said, I don't know if actually now it was the right thing to do. So as we go through this, we're going to explore what options this person may or may not have, or you might have, if you're in a similar situation. But let me share my whiteboard here. The first thing that I'm going to just focus on here is anything that we talk about in this webinar is education and not specific advice. Your situation is different than the person I'm talking about, than somebody else listening on this program, this broadcast. Your situation is very, very different and deserves direct advice given to your situation. Anything on this podcast, if you're listening on the podcast, on this webinar, is education, not advice. certainly today, because I'm going to talk about some tax implications. I'm going to talk about Social Security claiming strategies. But why change your benefits? Why might this person who said, well, geez, I started collecting in April. I don't know if I want to keep these benefits. What are my options? Why might someone change the strategy? Well, we have unexpected income. What if you're planning on retiring and you say, I started collecting my benefits. I'm just going to continue with April. I started collecting my benefits in April thinking I was going to retire in June. And not everybody retires on schedule. Some people say, well, they haven't found a replacement. I had one woman, she deferred her retirement, I think 3 or 4 years. It was like every June. Yeah, I'm going to do it this year. I'm going to do it this year. And it kept being pushed off. And that's not uncommon. Sometimes people get consulting agreements, consulting contracts. Sometimes they inherit money. And they have distributions or earnings. Sometimes they have vesting of stock options or restricted stock units. There are so many things that might trigger, well, geez, I have this unexpected income. Or you might just see, I have this unexpected effect. I didn't consider at the time that I made this election tax rates. Still not everybody realizes that a portion of your Social Security can be subject to tax, anywhere from 0 to 85% of your benefit can be subject to tax. It's not a tax rate of 0 to 85%. It's 0 to 85% of your benefit. So you may not be considering the taxes on your Social Security, and you may not be considering the effect of additional income that's potentially going to be taxed from your Social Security. And that could be, of course, marginal tax rates, could be capital gains tax rates, surcharges on capital gains for net investment income, or the ACA surcharge. We've talked about that many, many times. Certain tax credits. You might lose certain tax credits if your income goes over certain levels. You might lose certain tax deductions, like the bonus senior deduction is tied to your income, your modified adjusted gross income. You could also trigger this IRMA, income-related monthly adjustment amount. If you're collecting Medicare benefits, or if you're a couple of years prior to Medicare benefits, that could put you in a bracket that increases your IRMA surcharge, which can be significant. So you might realize that after the fact. And it could affect your overall tax planning. If Roth conversions are part of your overall tax planning, then it could certainly affect your Roth conversion strategy. If you, for example, had planned on converting $100,000 this year in 2025, and now suddenly, let's just say $25,000 of this new Social Security benefit is subject to tax, well, that might reduce the amount that you can convert by that $25,000, or make that conversion more expensive if it pushes that conversion amount up into a higher tax bracket. So these are just examples. I'm sure there are others. These are some examples of reasons that someone might want to change their strategy for their collecting their Social Security benefits. And so many people don't realize, most times when I say, well, you can change your benefits or stop your benefits, most people don't realize that that's possible. So I went to the expert, and when I decided, okay, we're going to, this is a good topic. So when I decided that this was a good topic for our webinar today, I went to the experts, and there's two options. So we're going to discuss the two options for changing, pausing, or stopping. It's really a pause of your Social Security benefit. So who are the experts? Well, you'll see her on our website. She's an amazing member of our team, Heather Schreiber. Heather's one of the top Social Security experts in the nation. I didn't, when I was chatting with her about this, I didn't ask if she's going to be in Austin with me next week at the Slott training event, but I'm sure she'll be there. That's where we met. And I wrote to Heather and I said, I want to talk about this on our webinar. I briefly discussed the conversation I had, and I said, do you have any good information you can send me regarding the options for changing benefits? And immediately, within minutes, I received this slide. And she said, yes, of course, I talk about this all the time. So I'm going to share with you this slide. And again, this is Heather's slide. So let's give Heather credit where it's due. So we're first going to talk about withdrawal of your application. So we're right here. We're talking about the withdrawal of your application. So this can be completed within the initial 12 months after filing. So think about that, with the initial 12 months after filing. So if this person says April, right? So April for of 2025. They could have until 4 of 2026 to change their mind, to say, we want to actually withdraw that application. Although they may not. We'll come back to this. Requires repayment. So you can withdraw your application. You get a do-over. You say, okay, you know what? I didn't mean it. I filed for my benefits, but I did some homework, or I realized some effects. I didn't mean it. Let me withdraw that application. This requires repayment of all the benefits previously received. So you've got to send the money back. You received these benefits. It could be $30,000, $40,000 and now, or more. And now you've got to send them back to the Social Security Administration. Withdrawal requests should be submitted using Form SSA 521. So you can't just call them. You've got to do all this, or you should do all. I wouldn't trust anybody on a phone call, but you should do all this by filing these documents. Any auxiliary benefits paid under the same record must also be paid. So if someone else is receiving benefits, if there's additional benefits, all benefits have to be repaid. This results in a full cancellation. Let me make this a little bit larger. Results in a full cancellation of the earlier claim as it never occurred. So it's a complete do-over. It's like it never happened. Allowed only once in a lifetime. And a new application for benefits must be submitted. So that's option one. Wait a minute. I didn't want this. I thought I wanted to start my benefits. I've changed my mind. What can I do? Well, you can withdraw your application, and these are the requirements. So I went back to Heather on this, and I said, I appreciate your slide, and I know it says initial 12 months after filing. And I explained that this person went back and retroactively received their benefits 6 months prior. And I said, I just want to check my understanding of this. What's the rule around that? And and Heather confirmed that it reverts back to the retroactive date. So if that takes us to, I guess that would be August of 2025, the Social Security Administration kind of put them in a bad position. Really only gave them 6 months to use this benefit, where they could withdraw their application because they got paid for that retroactive benefit. So I guess the reasoning is that's when the application is actually active. So this person could not use this option, this withdrawal of application. But they could do, because here today it is October 2025. But then we have the second option. So this is option one. Option two is voluntary suspension. So you contact the Social Security Administration to suspend benefits on or after reaching full retirement age, or FRA. You may not suspend until FRA or after. So this is when if people have received or started their application or started receiving benefits at age 62, 63, 64, etc., prior to their full retirement age, then their window is much, much smaller for this. So you may not suspend until your full retirement age or after. If you make a choice at age 62, for example, to start collecting your benefits, you have a year to withdraw the application, 12 months. You have 12 months to withdraw the application. If you miss that window, then you have to wait until your full retirement age for the next option, which is voluntary suspension. When you voluntarily suspend, you accumulate delayed retirement credits for every month benefits are suspended. So if you said, okay, well, wait a minute, I've missed my window to withdraw my application. I want to suspend my benefit and just wait to collect it. You don't give up the 8% a year, or it's actually a percentage per quarter. You don't give up those delayed retirement credits. They pick up again. For every month, the benefits are suspended. So they don't go back to when you start it, but they add up for every month that the benefit is suspended. Allows reversing a suboptimal claiming choice without repaying benefits received before suspension. You don't have to repay the benefits with a voluntary suspension. All benefits issued under the same record will also be suspended. Important to know, because if your spouse now is receiving a spousal benefit, if they're plussing up to receive that spousal benefit, then they're also going to lose that benefit. That was a change. Okay, I'm not going to guess the year, but that was a change several years ago now. A higher earning spouse used to be able to do what was called file and suspend, and the married spouse, the lower earning spouse, could keep that spousal benefit, but that option is now gone. So all benefits issued under the same record will also be suspended. Do not suspend benefits beyond age 70. No delayed retirement credits earned beyond age 70th birthday. There's no delayed retirement credits earned beyond the 70th birthday month. I talked about this in the webinar. There are so many confusing birth or ages now that are tied to retirement planning and IRA distributions and deductions and the tax code. And this is another one I heard somebody say, I guess it was a couple weeks ago, somebody who came to me after one of our educational series classes, and they said, yeah, I waited until age 72 to collect my Social Security benefits. And I didn't even go there because I hope it was age 70. But, there are so many confusing ages and dates. It used to be 70 and a half for required minimum distributions. Then it was 72. Now it's 73. If you're born after 1960, it's 75. You've got 59 and a half, you got age 55, you got age 50, you've got certain senior deductions that, are for certain ages. You've got certain contribution allowances that are only certain ages. So it's all crazy and confusing. And that's, again, one of the reasons that you have to work with a qualified professional. But don't delay. It doesn't make sense for most people, well, anybody really, to delay past the 70th birthday. And you must notify the Social Security Administration to resume benefit payments. So they don't come automatically. You've got to notify them. So there's two ways of changing your mind. You can withdraw your application. If that's not for you, it could be past the time or you just don't want to pay the benefits back. Then you have the voluntary suspension. All right. So that's expert number one. So I went to Heather Schreiber, part of our team. Expert number one, and said, Heather, you're the best I know at this. Again, one of the top 3 in the nations. I'm just going to say she's probably number 1 at this point. Heather is amazing. And every one of our clients gets the benefit of Heather working with her with their Social Security claiming strategies. And if that's not the number, it's certainly in the top 3 questions that we get with clients or prospective clients coming to us and saying, I need to make this decision. When is the best time to collect my Social Security benefits? Because I think there's still more than 500 different ways that a married couple then can decide to collect Social Security benefits, which is crazy. So I go to expert number 1. Heather Schreiber, Social Security analyst, to address these questions. Then I went to expert number 2. He's going to love this. Our resident CPA, Sasha Afanasieff, our chief financial officer, tax planner, and chief compliance officer. And I said, okay, let's talk about withdrawing your application. You could have somebody getting tens of thousands of dollars in their Social Security benefits. What happens when they pay that back? It's processing to me as I'm working through this. This makes nothing, but it's obviously clear if it's all done in 1 year. But if it's split, because I'm thinking about now, it's 10/29. So if we had somebody who started their benefit in April of last year and they didn't have that didn't have that retroactive issue. Let's just say that they just started collecting their benefit in April of this year, 2025. And then in January, well within the 12 months, they said, I realized this was a mistake. I'm going to withdraw my application and I'm going to pay back everything that I got in 2025 and so far in 2026. Well, that's a little messy from a tax point of view. So I went to Sasha and I said, okay, what are your thoughts here? And I'm just going to read along with you here. Sasha writes, if it all happens in 1 year, say 2023, it will be a non-issue as the Social Security Administration will offset the amounts on the 1099 SSA. They're supposed to anyway, he says, and that's a valid point. So the Social Security Administration is supposed to issue this 1099 to offset it. Hopefully it happens. Let's just say that. And if it doesn't, then you've got to be persistent about requesting it. And that's one of the things, record keeping is very, very important. And boy, isn't that one of the huge benefits that people get with working with this amazing team that we have, including Sasha, who keeps us all on our toes as far as record keeping. So the Social Security Administration will offset the amounts on the form 1099 SSA, or they're supposed to. And you would have a 0 1099 SSA for the year of initial benefits. He's using the year example 2023. As I said, and the reason that he's using the year 2023 is that's what the IRS publication, that's what they use in reference. So he writes, you would have a 1099 SSA for the year of initial benefits in 2023, for example, which is the same as the year of withdrawal. It gets tricky if the withdrawal happens the subsequent year. The person would have paid tax, if applicable, in the original 2023 of receiving benefits, for example. Since this is a full withdrawal benefits paid over 2 years, when they repay benefits in year 2, 2024, for example, the repayment would be greater than benefits received in that year. So a negative 1099 SSA would be received. Remember, let's just use $40,000. If the full benefit is $40,000, they receive $40,000 and they pay it back in 2024 in this example, for a combination of 2023 and 2024 benefits, then you've got this now overage paid back. You pay tax on potentially on some of that was sent to you, and when you send it back, it has to be reconciled. So first, a repayment is used to reduce benefits paid in that year. 2024 should already be reflected on 1099, resulting in a negative. But as noted above, the result will most likely still be a negative number. So a negative 1099 SSA is produced. The negative can be used to offset a spouse's Social Security if they are receiving a benefit in that year. If still a negative, it then depends on how large the negative amount is. If less than a $3,000 deduction, current year benefit plus spouse benefits if applicable, less current year repayment, there is no current year 2024 tax benefit as it is used to be allowed as a miscellaneous itemized deduction, but no longer. So I know that's confusing, and I had to read it a few times myself. And again, this is why, if you're deciding to make that decision, you have to, you really should work with somebody who's qualified, who understands it. And that's why I'm just going to plug our team here. That's why I love our team. So we have these experts that I can go to with just about any question. And boy, if we can't answer it here, we can answer it with the Slott group of experts that are, really, they're not part of our team, but boy, do we get a tremendous benefit from them every single year. And we're only one of 500 advisors in the country that are part of that group. It might be slightly over 500 now, but I'm very proud of that, and I just don't know why everybody's not involved. But our own local team here is really fantastic. Moving on, if the deduction is greater than $3,000, it is tricky and probably beyond the scope of our discussion. But here are two alternatives on how to treat this on your tax return. Note 2024 is a subsequent year in context. So again, this is from form, and I listed it down here. I'll show it to you again, but this is from the IRS publication 915, and I listed the website there that has the PDF. The deduction exceeds $3,000. If this deduction is more than $3,000, you should figure your tax two ways. Figure your tax for 2024 with the itemized deduction included on Schedule A of 1040, line 16. Figure your tax for 2024 in the following steps. Figure the tax without the itemized deduction included on a Schedule A, Form 1040, line 16. For each year after 1983, for which part of the negative figure represents a repayment of benefits, refigure your taxable benefits as if your total benefits for the year were reduced by that part of the negative figure. Then refigure the tax for that year. Do you have that? Subtract the total of the refigured tax amounts in subsection B from the total of your actual tax amounts. Subtract the result in subsection C for the result in subsection A. Compare the tax figured in methods 1 and 2. Your tax for 2024 is the smaller of the two amounts. So there's two figurings that we're doing, and then the tax is the smaller of the two amounts. If method 1 results in less tax, take the itemized deduction on Schedule A of 1040, line 16. If method 2 results in less tax, claim a credit for the amount from step 2C above on Schedule 3. And he goes on to list the schedules and how to write it. If both methods produce the same tax, deduct the repayment on Schedule A, line 16. And again, that can be found in IRS publication 915. So I recognize that is confusing. These steps are confusing. The publication, I don't know how many pages the publication is. I don't think I have it up anymore. But you can go through it and try to do these things yourself. If you find yourself that it makes sense for you to change your Social Security claiming strategy as far as timing This really has to do with timing. It's not if you're going to collect your Social Security. It's if did you collect it at the right time. If you want to talk about when is the right time to collect your Social Security, and this is looking forward instead of trying to unwind what you've done in the past, then that's a really, really great financial planning question to have. And I'm happy to have that with you. If you have at least $1 million in your investment accounts, including retirement accounts, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. Or you can reach out to us through our website at attleborowealth.com in the contact section, and you can schedule a 15-minute call with me. But that's a really, really great financial planning question to have. The question about when to collect Social Security benefits. If you've never heard this before about, well, geez, I might be able to undo my election for Social Security. You might be regretful, kind of having that buyer's remorse about your Social Security election. Yes, you may be able to suspend it, or you even might be able to withdraw that application if it's within the timeline. But if you received those benefits and withdrew that application, you have to pay it back. And it can get complicated, as I shared with you. So I rely on the experts, and you should too. Don't try to do this, don't try to do this stuff at home on your own, because it can get very, very complicated. I know that I hear this all the time from people. My return's very simple. And then you look at it and it's not so simple, or there's things that have been missed. And these things can get confusing. And this is just one example. So I thought this was a great opportunity to bring you some information about something you may not know about. And that is, if you've made an election for your Social Security and you're not, and you're regretting it, you think there might be better options, you may have an opportunity to undo it or suspend it. And the other thing is, I wanted to highlight the expertise of our team, because this just came together so nicely for me. And I have this experience day in and day out, whether it's Heather, Sasha, Emily, Lydia, Jessie, Jessica. She's like, a person who's been working with me now for 17 years and knows so much about account transfers and rollovers and things that you're just ordinary people don't know, or even people that have worked in this business for a long time still don't know. She knows more than many financial advisors, but and Turia and Alyssa and this team are just a group of specialists and really experts who I can rely on every day. And you can too, if you want to talk about how that works for you. So that was a little bit of a pitch, and I appreciate you listening to that. But I'm just so proud of this group, and I love the way these things come together. So let me finish with our announcements. So I'm just going to pull up our announcements here. And we've got some things coming up. I'm very excited. I shared with you that next week there will be no webinar. I'll be in Austin, Texas. I'll be attending the Slott training update for a few days down there. I'm very excited about that. I know you all can imagine my excitement and join me in my excitement to learn about IRA distribution strategies and tax law updates. And I know everybody says, boy, how can I do that too? But if you're a financial advisor, CPA, or attorney listening to this, you should be doing this too. Tomorrow, we have a special event at our office, 1051 Lindenhurst Road in Yardley, Pennsylvania. And that is a shredder and electronic recycling event. If you're a client, you've already been invited. I hope you've already registered. Registration is very important for a couple of reasons. First of all, we want to know who's coming. And second of all, along with document shredding and electronic recycling, we have Jay's Joint food truck, Philadelphia cheesesteaks, the famous Philadelphia cheesesteaks. And Jay's cheesesteaks are amazing. And we had to give them they bake the rolls fresh every day. So we had to give them a hard count of who's coming and how many cheesesteaks we need. So we've got a hard count for them. So first of all, if you've registered, please come hungry, or plan to take your sandwich home. We'll have some areas. It's supposed to rain like heck tomorrow, but we're still having this event. We've got some tents we're going to have. But this is our first Attleboro Wealth Management Gives Back, and we're very excited about this. So not only did we invite clients, if you're on our email list, we've invited you. We've invited members of the community, certain members of the community. So we reached out to our American Legion. We've reached out to our local theater group that I'm involved with the Newtown Theater, the 1,000+ members they have, and our local Rotary Club. We unfortunately couldn't open it up to the entire community because That would be huge. But we're really excited about this and looking forward to it tomorrow. So that is tomorrow here at the office, October 30th from 11 to 2. And that is our first Attleboro Wealth Gives Back. And it's going to be a shredder event with electronic recycling. And of course, Philadelphia cheesesteaks. I told you that I'm going to be away next week, so there'll be no webinar. We've got our Encore Changing World of Retirement Planning class series scheduled for the Princeton area, Mercer County Community College. This was an overflow. We had I don't even remember the number. I think it was 140, 150 people that wanted to come to the class that we had in September, but we couldn't accommodate everybody. So we were able to put together another class series, and that is November 13th and November 20th. So November 13th and November 20th is the next series from 6:30 to 9:30 on both nights. It's a 2-class series. So if you're registered for that, plan on being there both nights. And if you're not registered and you want to, you can email us at questions@attleborowealth.com. That's questions@attleborowealth.com, or go to our website at attleborowealth.com and send us a message. I hope that was helpful today. We went over a lot during our weekly webinar. We focused on the options for you for making changes to your Social Security benefits, including how you do it and some tax implications. We talked about the experts that helped me with that and the experts on our team. And I hope that was all great education for you. I hope it continues to move you forward in your journey. Remember my goals for you, and that's to stay educated. Stay educated so that you can make changes in your plan. Think of things differently. We do things differently, and we're proud of that. So don't be afraid to think of things differently. Many of us have been taught for decades how to do things that may not be proper for us. So you want to start looking at things differently. Think about tax planning in your retirement plan. Think about longevity planning in your retirement plan. Think about long-term care planning in your retirement plan. But many, many people don't consider the tax implications. They don't really think about investment management along with the financial plan. So think about these things differently. Use the resources that you have with us with this weekly webinar and other things that we push out on a regular basis to stay educated and stay updated so you can make changes to those plans as needed and review them every year. So come along with us every week, and as we meet, and if you want to meet us in person, if you have at least $1 million in your investment accounts and you want to meet us in person, again, I'm happy to schedule time with you for a 15-minute discovery call. If you're already a client, we appreciate you so much, and we hope to see you all tomorrow at the shredding event and in a couple weeks when we come back for our next webinar. Have a great day, everybody, and enjoy the rest of your week. Take care.